A man in a worn jacket stands at a gas station pump at 11 p.m. He slides his card. Declined. He checks his balance on his phone. Negative $12.47. Not because he spent too much, because a subscription he forgot about charged at 2 a.m. 3 days ago, and then a $35 overdraft fee hit, and then another $35 fee hit the next morning because the first fee put him negative again. Across town, a woman in Kashmir is on a phone call with her banker. She is not calling to complain. She is calling to ask if a wire to Geneva cleared before the market opens. It did. He is calling to tell her. Same city, same night, same institution. Here is something no banker will ever say to your face. The same institution treats you like a different species depending on what is sitting in your account. Not a different customer, a different species. Every smile, every fee, every ignored phone call, every time someone remembers your name, all of it is a function of one variable, your balance. Here is exactly what happens to you at every level, starting from the bottom. $0. Negative, actually. Negative $12.47. You walk into the branch on a Tuesday afternoon. The line is short, 2 people ahead of you. Neither of them looks like they are here for good news. When it is your turn, you hand the teller your card. She does not greet you by name because your name has not earned a greeting. She processes the transaction. She processes you. The distinction matters. You are not a person standing at a counter. You are a balance on a screen. The balance is negative. The balance is a liability. Something in her face changes when she sees the number. Not dramatically, just a quiet recalibration. A professional neutrality that functions like a wall. Is there anything else I can help you with today? The question is scripted, not an offer, a transition. It means the transaction is complete and you're expected to leave. You leave. Here is what $0 actually buys you. Not a service, a processing. The bank's systems categorize your account automatically. Negative balance triggers a flag. The flag assigns a risk score. The risk score determines which scripts the teller sees on her screen. She does not know she is following a script. The script is invisible. It functions like judgment. It is not judgment. It is architecture. $35. That is the fee for being $4 short. The penalty for poverty is not sympathy. It is acceleration. The less you have, the more they take. Not because anyone decided to punish you, because the system was designed to treat insufficient funds as a revenue stream. The fee hits, the balance drops further. Another fee hits. The spiral does not require a human decision. It is automated. A machine calibrated to feed on the people who can least afford to feed it. The fees drain what little remains, and the balance drops further still. You check your phone in the parking lot. Negative $87.47. 2 fees in 48 hours. Here is the architecture of the spiral. The system is working exactly as intended. $2,000. $2,000. A basic checking account with direct deposit. You walk into the same branch, same Tuesday. The teller does not know your name, but she does not look at your balance with the same recalibration. The number is positive. The number is small, but it is positive. That changes everything. You deposit a paycheck, $847. The teller processes it. She asks if you would like to open a savings account. The question is not personal. It is a prompt on her screen. Your balance crossed the threshold. The threshold triggered an upsell protocol. The system has determined that $2,000 is the point where a customer becomes a candidate for a second product. Not because you need it, because the bank's retention models show that customers with 2 accounts are 40% less likely to leave. Here is what $2,000 looks like from the inside. You are no longer a risk. You are a prospect. The distinction is subtle but structural. At $0, the bank is protecting itself from you. At $2,000, the bank is cultivating you. The shift is invisible to you. It is not invisible to the system. The fees still exist. Monthly maintenance, $12. Overdraft protection enrollment, $5. Out-of-network ATM surcharge, $3. The monthly maintenance fee alone drains $144 per year from an account that averages $2,000. The bank does not call them fees on your statement. It calls them service charges. Here is the function of the language. A fee sounds like a punishment. A service charge sounds like something you received. You did not receive anything. You paid for the right to keep your own money in their building. The ATM is still your primary relationship with the institution. The teller is a backup. The branch is a place you visit twice a year when something goes wrong. The bank doesn't mind. At $2,000, you are not expensive to maintain. You are not expensive to lose. The math is neutral. The system is patient. $25,000. $25,000. A savings account, a checking account, a credit card with a $5,000 limit. Something changes when your balance crosses $25,000. Not dramatically, a quiet recalibration, the kind that happens inside a system before the system tells anyone it happened. You walk into the branch. The teller greets you by name, not because she remembers you, because your name appeared on her screen with a notification. Premier Customer. 2 words that change the architecture of the interaction. Here is what those 2 words unlock. The monthly maintenance fee disappears. The out-of-network ATM surcharge disappears. The overdraft protection enrollment fee disappears. The bank does not call these fee waivers. It calls them relationship benefits. A waiver sounds like a favor. A benefit sounds like something you earned. You earned it by having enough money to make the fees irrelevant. The teller asks if you would like to speak with a personal banker. Not a teller, a personal banker. A person whose job is to sit in a small office with a glass door and discuss your financial future. You sit down. The banker offers you water. You say yes. The water costs the bank 4 cents. It functions like respect. Here is the mechanism. The personal banker is not providing advice. He is providing a product pipeline. He offers a certificate of deposit. He offers a money market account. He offers a credit line increase. Each offer is a data point on his performance dashboard. He does not know he is being measured. He is. The system tracks every conversation, every offer made, every offer accepted. The conversion rate determines his bonus. You are not a person having a conversation. You are a pipeline with a $25,000 balance that the bank would like to see grow, because a $25,000 balance generates approximately $62.50 per year in interest spread. Not enough to matter to the bank, but enough to matter to the system that measures every dollar in every account across every branch. Here is the calculation behind the warmth. At $25,000, the bank invests in keeping you, not because it values you, because the math says a retained customer is cheaper to maintain than a new one. The warmth is a function of the balance. The balance is a variable. The variable determines everything. $150,000. $150,000. Premier status, platinum debit card, a dedicated banker with a direct phone line. You do not wait in line. Not because someone recognizes you, because the system has flagged your account and the branch manager has been notified of your arrival. Not by name, by balance category. Platinum member in the lobby. The manager does not know your name yet, but she knows your category. The category determines the response. Here is what $150,000 buys. The bank stops processing you and begins managing you. Your dedicated banker calls you. Not you calling the bank calls you. The distinction is structural. At lower levels, you initiate every interaction. At $150,000, the bank initiates. The phone rings on a Thursday afternoon. It is your banker. She's calling to let you know that a CD is maturing next month and the current rate is favorable if you roll it over. She has already prepared the paperwork. She has already calculated the projected yield. She has already compared it to 3 competitor rates. You did not ask for any of this. The bank decided you needed it. Here is what shifts at this level. The fee architecture inverts. At $0, the bank charges you for existing. At $150,000, the bank pays you to stay. No fees, no minimums, free wire transfers, free cashier's checks, free notary services. The bank does not provide these because it is generous. It provides them because the revenue from lending your $150,000 to other people at 8% while paying you 0.5% generates approximately $11,250 per year. The free wire transfers cost the bank $18. The math is not generous. The math is strategic. Your banker knows your spouse's name, not because you told her, because your joint account lists it and the CRM system populates her screen with your household profile. She asks about your daughter's soccer tournament, not because she cares, because your daughter's tuition payment appeared in your transaction history and the system flagged it as a life event. Something crystallizes at this level. The warmth is data-driven. It functions like personal. It is not personal. It is execution. At $150,000, you are no longer a customer. You are a portfolio. The bank manages portfolios. The bank does not manage people. $750,000. $750,000. Private banking. A wealth advisor assigned to your account. An office at the branch you can use. You do not go to the bank. The bank comes to you. Not literally, not yet, but functionally. Your wealth advisor calls quarterly, not to sell, to review. The language changes at this level. Review your portfolio, assess your allocation, rebalance your exposure. The words are longer, the sentences are smoother, the tone is collaborative, not transactional. Here is what $750,000 reveals. The bank begins to treat your money as a relationship, not an account. Your wealth advisor does not work for the branch. She works for the private banking division, a separate entity within the same institution. Separate offices, separate systems, separate protocols. The private banking division does not interact with the tellers. It does not interact with the branch managers. It exists parallel to the retail bank, visible only to people whose balance grants access. Your advisor reviews your accounts, your checking, your savings, your investment accounts, your retirement accounts. She sees the complete picture. Not because you assembled it for her, because the bank systems are integrated. Every account you hold at this institution is linked. Every transaction generates data. The data feeds a profile. The profile feeds a strategy. The strategy feeds a recommendation. The recommendation is presented as advice. It is not advice. It is a product map. Here is the hidden architecture. At $750,000, the bank's profit model shifts from fees to lending. The bank wants to lend your money to other people. More precisely, the bank wants to manage your money so that a portion of it is deployed in loans, bonds, and credit facilities that generate interest for the institution. Your wealth advisor's bonus is partially tied to the assets she manages, not the returns she generates. The assets. The distinction matters. She is incentivized to keep your money in the system, not necessarily to grow it. The system does not tell you this. The system presents a face of fiduciary care. The face is professional. The face is warm. The face has an office with leather chairs and a view of the city. Here is what the bank actually sells at this level. Behind the face, the machine is lending your $750,000 to someone who is at $0 and paying 24% interest on a credit card. Your money is the raw material for the machine that processes the person at the bottom of this ladder. $10 million. $10 million. The bank does not have a service tier for this. It has a department, wealth management, family office services, institutional level access. You do not have a banker. You have a team, a relationship manager, an investment strategist, a tax advisor, an estate planner, a person whose only job is to coordinate the other 4 people. The team meets quarterly in a conference room at the bank's regional headquarters, not at a branch. Branches are for retail. You are past retail. Here is what $10 million eliminates: the concept of a fee. Not all fees, the small ones: wire transfers, cashier's checks, notary services, foreign exchange conversions. These are absorbed into a relationship structure that the bank calls comprehensive wealth management. The fee is not gone, it is bundled. You pay an annual advisory fee of approximately 1% on assets under management. On $10 million, that's $100,000 per year. The bank does not itemize this. It presents it as a single line: advisory services. The word services does the work of making $100,000 feel like a relationship rather than a transaction. Here's what $10 million creates: The bank systems begin to function not as a service provider, but as a partner. Not a real partner, a structural partner. The bank participates in your deals. It underwrites your loans. It facilitates your acquisitions. It connects you with other clients in the same bracket. The bank becomes a node in your network. Not because it likes you, because a $10 million client who uses the bank for business lending generates revenue across multiple divisions: commercial lending, investment banking, treasury services. You are no longer an account. You are a revenue vector. Your relationship manager visits you, not at the bank, at your office, at your home, over dinner if the occasion requires it. The visit is not social, it is strategic. The bank is maintaining proximity to $10 million because the cost of losing it is measurable. The system has calculated the lifetime value of your relationship. The system has assigned a retention budget. The dinners, the golf outings, the tickets to events, these are not perks, they are investments. Each one has a cost and an expected return. The bank knows your net worth. It knows your income. It knows your spending patterns. It knows your tax situation. It knows your children's names and their trust fund balances. The system has built a model of your financial life that is more detailed than the model you have built yourself. You did not give the bank this information in one sitting. You gave it in fragments over years. The system assembled it. At $10 million, the machine does not process you. The machine sustains itself through you. You are not at the top of the ladder. You are part of the ladder. The machine uses your money to build the rungs that the person at $0 is standing on. You are the same human being at every balance. The teller who didn't look up and the relationship manager who flies to your office are both responding to the same variable, the number next to your name. The number determines the warmth, the speed, the memory, the anticipation. Everything else is decoration. The person standing at the gas station with a declined card and the person on the phone with Geneva did nothing to earn their treatment. Neither one chose their balance. The balance chose them. Or rather, the system chose what to do with them based on what the balance said. The bank does not close at 5 p.m. The systems run overnight. Fees post at 2 a.m. Algorithms recalculate risk scores. Automated processes drain money from accounts with too little and direct it towards accounts with too much. The machine does not sleep because the machine does not need to sleep. It only needs to process. It processes 24 hours a day, 7 days a week, across every branch, every ATM, every server, every database. The machine is not broken. The machine is doing exactly what it was built to do.